Okay, this example looks at ROI and decision making. So before we go on, hit pause and read the question carefully. And if you want, you can attempt it and look at the answer, and then I'll quickly highlight a few points. Okay, so hopefully you've read it now. Just quickly something on ROI decision making. Now ROI is an accounting number, and remember, for decision making we are interested in cash flows. But if your depreciation is close to your capital expenditure, then your profits might approximate or be used as a proxy for cash flows. And then we might compare the ROI to the weighted average cost of capital for investment decision making. ROI will then be a proxy for IRR. Remember, IRR, internal rate of return, that you do alongside net present value calculations, uses cash flows, but here we use accounting profits. Because of this question, important things to see: they give you the industry growth rate of 8.4%, they expect that to persist in the future, and this company is currently running at 90% capacity. Now that's important because when you reach 100%, you'll need to spend more fixed cost, which will increase your break even. Then they give you an income statement, tons of paper at the current level. Now let's look at the solution and highlight a few things. So they calculated the break-even here by saying fixed cost plus target profit. Remember, we're looking at a target profit calculation here because they said they need to earn 750 million in 2016. So in 2 years' time, that's what they're going to need in order to have a ROI that's higher than the weighted average cost of capital, or in order to break even from a cash flow perspective, in inverted commas. So why do I say that? Because remember, investment decision making uses cash flow, so that's IRR, but here we have information to calculate ROI. So we're just using ROI as a proxy for IRR. So in short, the break even will be when we make a profit before tax of 750 million. So why is the fixed cost only 7,698 million instead of the 8,966? Well, this 1,268 here is an exceptional item. It's impairment of non-current assets and other exceptional items. That is not expected to happen again, so we only take the fixed cost. Remember, we're working out the break-even in 2 years' time. And then the contribution per unit was just the contribution given divided by the tons given. So that gives us break-even of 4,653 million tons. Now, how do we interpret that? Here, the first thing is to calculate what should our growth be in order to reach that. And that will be roughly 10%. So you can look at the calculation there. And if you compare that to the actual growth anticipated in the industry, which is 4.8% for 2 years, that's 9.8%, we need to grow faster than the industry in order to reach the break-even. Now, what's the problem with that? We've been losing market share, so now we need to gain market share just to break even. So how realistic is that? Another thing is our break even is so close to our full capacity. Where does this full capacity come from? It's current capacity divided by the 90% will give us the 100% of capacity, and you can see the break even is close to that. And you can't operate that close to maximum capacity without running into downtime or capacity problems. So what happens if you go over 100%? You have to spend more fixed costs, so that will increase your break even again. So that's a problem. Then what needs to happen? They need to increase their margins. How do you increase margins? Well, one or two things. You have to increase your selling price or decrease your variable costs or your input costs. If they could decrease the cost, they would have done it by now, so that's unrealistic. And how realistic is it to increase your selling price in a competitive environment where you are already not doing that great? So in order to increase the selling prices, they're probably going to have to diversify or make better quality paper than the competitors.